Defying the stereotypes, breaking the rules. You can't tell me what is for me. Yeah. You got a lot more behind those pretty eyes, but you gotta let the world see. Yeah. So shake it out. Now is the time while you're waiting. Feel good enough. Now is the time while you're waiting. What are you waiting on? Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Don't let them bring you down. If they ain't rocking with you, so what? Yeah, you're gonna be cool without them. Oh, don't let them bring you down. Don't let them bring you down. Oh.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the NASDAQ Daily Stock Update for September the 1st, 2020. We have a lot of really good information to share with you today about two particular stocks. We're going to talk about Citrix Systems, and we're also going to talk about Dollar Tree stores. Two really, really dynamic stocks that are out there. But before we begin, I want to remind all of you that are out there, if you're listening to this with the intent of to improve your retirement, then you're in the right place. There's really only three reasons why people save money for retirement in stocks. Number one is going to be the growth that's associated with it. Number two is going to be the dividends. And number three is going to be, it's just diversification. People like stocks. And nowadays it's grown dramatically more with discount brokers and with no fee trading. It's grown tremendously. If we go back to the first idea about investing for growth, you might not think that being in retirement that you should be investing in stocks as much. But if you strategize properly, you should be able to use stocks quite efficiently in your retirement strategies. If you use a strategy that I recommend a lot, which is called bucketing, what you do is you take and you set aside money in certain segments for certain time periods. In other words, let's say that we use three buckets. We use a bucket that's based on 1 to 10 years. Then we use another bucket that's based on 10 to 20 years. And then we have the last bucket, which is based on 20 and beyond. Because if you're retiring today, you should plan on having a long, comfortable retirement. And one of the best ways to do that is by planning on growth so that you can utilize it in later years. That point I want to bring up today is even more important than it's ever been, because the possibility of Social Security being reduced is a real possibility. It's up to you to captain your own ship for retirement, to make sure that you're saving for yourself. The way that Social Security is right now, the trust fund in itself will go barren. It's supposed to go barren, let's say, in 2035. With the COVID-19 reducing money that's going into the Social Security Trust Fund, that projection's been reduced down to about 2029. Now that we're having even less money go into it because we're postponing payroll taxes to help the economy, it could be shortened even further. So what's going to happen when the payroll trust fund goes bankrupt? Now, that does not mean that if you're on retirement that you're going to lose your Social Security. But what it does mean is it means that there will be a reduction. The Social Security payments right now can be sustained at about 79% of their current levels with just contributions from FICA. That is the payroll taxes that are going in. If they continue to go in, then you're still going to be able to get an income, but it's going to be reduced. That's probably not going to happen, but we can't say that it will until Congress gets off its duff and actually does something. And you have the Republicans and the Democrats that actually talk to each other. And that's got to happen at some point in time. There are certain types of issues that they will discuss. It's probably not going to happen before the election occurs, but it's one of those things that's going to happen. But you should plan on future growth, saving your money just in case there is some sort of a reduction. The probability is that if you're in retirement right now and you're receiving Social Security, that you probably won't have any type of disruption in the way that your income is coming in. But if you're not receiving Social Security yet, what has happened with past changes in law, in tax law and in Social Security and that type of system is that future benefits have been reduced for people in the future. So get used to some ideas of saving more money for the future. So that's my spiel on why you should save money in growth. But let's get on into talking about the stocks that we're going to talk about today. We're going to talk about Citrix Systems, and we're going to talk about Dollar Tree. So let's add this into the screen and get talking about it. These are the two feature stocks. Okay, let's go ahead and start looking at the two stocks in themselves. We throw the spaghetti graph up there, and you can see how they ended up today. Of course, the NASDAQ itself ended up today over 1%. It just seems like you just keep hearing that and hearing that and hearing that. And you know that there's going to be days out there where it's going to be less. So just don't get too accustomed to it from that standpoint. And one of the themes that I want to communicate to you today is that even though that expectations may be at a certain level for some stocks, even when they hit their expectations, if the general market expects more, it can have a negative effect on the stocks. And that's what you're going to see in both of these stocks today, because Citrix Systems and Dollar Tree have had good earnings per share, but there are times when the earnings per share were not exactly what the market was expecting. And as a result, those particular values dropped. So we're going to see how that worked today. Now, the way that the day ended up in itself, Citrix Systems ended up just a hair over its beginning value. Although Dollar Tree got hammered, it was down 2.69% for the day. As we go on and we look at Dollar Tree and Citrix Systems, we want to compare that really to the NASDAQ 100 and to the S&P 500. You see, the point of this show is we're looking at really the stocks that are in the NASDAQ 100. The NASDAQ is a computerized stock exchange. Some people call it the over-the-counter exchange, although it's not the only over-the-counter exchange. It's a completely computerized exchange that exists where the stocks are just traded on, electronically. When I say, maybe you don't know. If you compare that to the New York Stock Exchange, you've probably seen pictures of the guys down there on the trading floor, and they're saying, bid up, bid down, etc. That doesn't happen in the NASDAQ. There are about 3,500 stocks that are in exchange, and the ones that we focus on in this show are going to be the top 100, the NASDAQ 100. The two that we're talking about today, Citrix Systems and Dollar Tree, when you compare it to what happened in the overall NASDAQ 100, it's going to be less. And one of the biggest reasons is because the NASDAQ is dominated by tech stocks. Some people think of it as just a tech index, and it's obvious that it's not, because if you look at it, you know that Dollar Tree is not a tech stock, but that's okay. The diversification of the index is good. So when you have an index fund that's based off of the NASDAQ, then you've got good diversification. And that's one of the things that we do for clients is we help them to invest directly in the index. You can own all 100 stocks, and you can own it proportionately the way that the index exists without going through an exchange traded fund or without going through a mutual fund. That has a lot of benefits to it. And if you want to learn about direct indexing, go over to my YouTube channel and watch the video on direct indexing. But as we get back into talking about what we're talking about today, we want to bring in also the subject of the S&P 500, because the S&P 500 is kind of like the benchmark of everything. When we talk about the statistic of beta, we're talking about the volatility, how much up and down these stocks go. And it's all compared to the S&P 500, because what's happening is when we look at that statistic, everything is based on the S&P 500, and the beta of the S&P 500 is 1. So since it's 1, everything on it, if it's going to be less volatile than the S&P 500, it's going to be lower than 1. If it's going to be higher than the S&P 500, it's going to be greater than 1. Well, what good is that to you, you may ask yourself. Some people don't want to invest in stocks that are highly volatile. Today is going to be a little bit of a contradiction in the way that that is perceived. That may be the way that the definition is in Investopedia, but you're going to see in reality today, especially when we start looking at Dollar Tree, the volatility of Dollar Tree looks higher than that of the S&P 500, although the statistic, the number is lower. But we'll get into that a little bit later. Remember, though, the S&P 500's beta is 1. So let's keep going on today and talk about the individual stocks. As we begin and we're talking about Citrix, let's talk about what they do. This is a really interesting company. I created a video earlier and we talked about how to invest during a recession. And what I suggested to people is to look for stocks that are actually benefiting from the recession. And that's what's happening here. Citrix is one of those stocks that's actually benefiting from the pandemic, the COVID-19 pandemic. And the reason is they create digital workspaces. They create a good atmosphere, a good environment, a online environment, that is, for people to work from home and to work remotely. Their digital workspaces predominate what their business is. However, they also work in networking and analytics too, which adds to what they do. When we compare the company to other companies that do similar things, VMware is probably the closest thing to it. There was another company that was publicly traded actually until this past month. It was called LogMeIn, and you may be familiar with that, but that was actually bought by a venture capital company. But so we can't really compare the stock value of that since it's not publicly traded. But that's another company that does do the same thing or similar thing that Citrix does. VMware competes also. Cisco and Microsoft do as well, but they're more diversified, as you may be familiar with both of those companies. So if we look at what's actually happening here, if you follow the dancing cursor, you see right here is between February and March when the market started to go wacky with the pandemic in itself. And what happened is Citrix really took off. It was really an amazing run of what happened because there were so many people that were working from home, and they have a system. This is their wheelhouse. They have a system, their work environment system, their cloud system is designed for efficiency in employees working remotely. So it worked very well, and they've expanded dramatically. The other companies that do this similar thing haven't done quite as well from that standpoint. If you look at VMware, which is down here just a little bit, it's closer to what Cisco was doing, and then Microsoft followed behind it. Now, we're going to talk more about what this great big jump was over here in just a few minutes, but let's keep going on and talk about what went on specifically. If we look at earnings is what's driving these stocks. And a lot of times the anticipation of what might be happening has a big impact in the value of the stock. And that's what happened with Citrix Systems. When we look at it from that standpoint and we compare it to the S&P 500, it is a stock that goes over top of that index quite a bit. And when we look at what the beta is, this is where I was talking about contradictions a little bit ago. When I tell you that the beta of a stock is X, that means it's going to be comparing it to the S&P 500. So when we look at the beta of Citrix Systems and we see that it says 0.31281, that means that this should be dramatically less volatile than the S&P 500. However, the number is deceiving at this point. And the reason is because the stock did so well right after the pandemic hit, because the systems were being utilized dramatically, kind of the way that Zoom is. That's another stock for another day that has benefited from the COVID-19 storm. But what we're seeing is that even though that it is more volatile up and down, if you follow the dancing cursor, you can see that the volatility, there's more of it here than there is here. But the thing that makes it a lower number than the S&P 500 is the fact that it had such a dramatic increase here as opposed to here. When the S&P 500 was dropping, Citrix was surging, and that's the reason why that we see a lower beta. So if you're out there searching for stocks with low beta because you think that they're going to be less volatile, don't be deceived. You could see a stock like Citrix System, which is kind of a contradiction of that in itself. If we look at the PE ratio of this stock, it's actually got a good PE ratio. That's the profits, earnings per, excuse me, let me get it out there for a minute. The profits, earnings per share in itself. Can't think what I'm going to say today. Okay, so it's at 30.24. And when we compare the PE ratio to that of the S&P 500, the average S&P 500 stock, and I go over to my notes here, and I can see that basically they're about the same, 30.24. So you see that the two are neck and neck from that standpoint. I think a lot of that's because the volatility is evening out. We're looking at this over a period of a year. Okay. Let's talk about this. When you see a stock that drops so much, you have to ask yourself, what the heck went on? There must have been some sort of bad news that hit the market or something like that to see such a drop as we're seeing here. Not exactly. This is a report from Motley Fool that I think hits it right on the head. And it says that it got crushed. It was down 11%, but the second quarter earnings were actually over top of what the company said that they were, or over top of the expectation, but the market expected it to be higher. And just because the market's expectations were higher, we saw an 11% drop in one particular day. When we look at the actual valuations, this is from Morningstar. Morningstar rates this stock as a 3-star stock. I want to remind you again, as I do every single day, that the star system that Morningstar uses, it's not like going to a restaurant. When you go to a 4-star restaurant, if you think Gordon Ramsay is going to pop out and give you a great meal, you might be surprised. It might happen. It's not the same thing with the rating system that goes on with stocks. It's based on value. If you have a 3-star stock, then basically what it means is they're looking at the value, which is based on earnings per share. Generally, it's about 15 times earnings per share is the fair market value. So the fair market value that Morningstar is saying exists on this particular stock is $141 per share. And it's just a hair over top of that at $145.23. So you can see that it's got a little bit more room to grow. Let's look at what some of the other analysts that are out there have said about this particular stock. If we want to, I'm going to go over here and make just a little bit bigger so that if you're on your phone or something like that, you can actually see what I'm talking about. And in this particular instance, we're looking at what analysts have said, what the average analyst, and in this particular circumstance, there are 11 analysts that were polled, and 4 of them said that it was a strong buy. 1 of them was moderate. 6 of them said to hold from that point. Now, I want to remind you that when I report to you what the analysts are saying, don't take this as the gospel and say, I got to go buy this stock. You need to look at your situation, and you have to know what your situation is financially right now and for the future before you go and use this as a determining factor for buying the stock. But when we look at it from the standpoint of the average analyst out there, the average analyst is As we're keeping on going on here, all right, let's look at the moat that exists on this to look. If you've never joined me before, I need to explain to you real quickly what the moat of a stock is, and that's this. Remember that the moat of a stock is going to be the potential for sustained profitability. If you have a wide moat, that means that you've got a wide potential for profitability. If you have a narrow moat, then you have less sustained profitability. Now, when we get to Dollar Tree in a few minutes, I'll remind you about that. Dollar Tree doesn't even have a moat. In other words, their competition is really chomping at the door, so they don't have any particular edge. The edge that goes on right in this stock that gives it a narrow moat is switching stock. Let me rephrase that, is switching cost. And I repeat this all the time, and I'm going to tell you, if I was doing marketing for whatever company that's out there, if you wanted to compete with this company, you would try to find a way to eliminate the switching cost, because that's a big deal. If you look at Citrix systems, one of the biggest reasons why companies stick, why customers stick, is because the switching cost that goes on with it. Hold on here. All right. So every time we look at the reasons, there's two real reasons why switching costs are so big for a company like Citrix. One is it's not actually just the financial cost of it. In other words, just going out and buying access to the system. It's the time and effort it takes to change. And if you have a company that's working remotely from home and you're using the Citrix environment for your employees, getting everybody to switch when they're off of campus at one time is a big deal. So the switching cost is a benefit. The other thing is, when we look at what else they do have a foothold in networking. And if you're going to change networking systems, the intrusion risk is really big in switching networks. If you're going to go from one network to another, you expose your company, your data financially from that standpoint. So those are reasons why this company has a sustained profitability. It's not as big as some because there is some competition that exists that's out there. Now, one of the other big deals that goes along with this company is this.
The beauty of your side.
If you listen to the very beginning of the show, you heard me talk about the 3 reasons that people invest in stocks during retirement. And one of the biggest ones is dividends. The dividends on this stock are 0.96%. And one of the things that we do in direct indexing, in other words, if we're going to buy just the stocks of the NASDAQ 100 that pay dividends, that works very good for retirees, because if you're looking to collect dividends, you want to get just stocks that are paying dividends. But if you're just relying upon stocks for dividends, you have to remember that there's no guarantee that they're going to exist. So diversification, and if you had 100 stocks that are in the NASDAQ 100 and let's say 70 of them pay dividends, you have a good diversification so that if there's some changes in companies paying out dividends, then you've got more diversification that goes along with that. So this is a stock, if you're a retiree, that you would probably want to consider because it has a forward dividend of 0.96%. Forward dividend means basically that's projecting into the future of what's going to go on. But remember, when I tell you about projecting, the past performance of these stocks is no guarantee of what's going to happen in the future. So keep that in mind as we go forward here and look at the next issue. Let's jump right into Dollar Tree. Now, Dollar Tree is not going to pay a dividend, but it's a good stock from the standpoint of growth. And it's another stock that's actually benefited from the pandemic because people are trying to stretch their dollars. So they're going to discount stores. Although this is another one of those stocks that, even though that they're meeting the expectations of what the analysts have said, sometimes the market hits them hard, and that's what's happening here. You're going to look at the graph in a moment. You're going to see that they actually hit their expectations for their earnings, but they had a day where they got hammered and they were down 2.69%. If we look at the competitors that are out there for Dollar Tree, you're going to see Dollar General, Five Below, and Big Lots. Big Lots is another company. If you look at the graph, you follow the dancing cursor, wow, Big Lots has just really been taken off dramatically from that standpoint. Now, we're not here to talk about Big Lots as much because that's not what we're focusing on, but I will tell you that Big Lots is a lot smaller company than Dollar Tree, and it has hit the market by storm, and it's benefited. Some of these discounters have benefited from that standpoint, from what's going on with the pandemic. Okay, but if we look at it, if you follow the dancing cursor, you can see this is actually where the market tanked right after February and March, where things went down. Then all of a sudden things started to take off. Big Lots shot off like a rocket, and it's continuing to go up. It had a down day today in the last few days, but it's actually been pretty good. When we look at Dollar Tree is going to be the company that's in blue, and it's actually followed along with Five Below about the same. And when you look at Dollar General and Dollar Tree compete pretty well with each other, and actually from a standpoint of valuation, they're continuing to do a little bit better than Dollar Tree in itself. And we'll talk about those stocks on another day. But when we look at what's happening right now with the value, I want to bring this up, and I want to make sure that you can see this. So I'm going to increase the size on this just a little bit. This was the earnings that were projected and what ended up happening. 9 analysts projected that the earnings would be 85 cents a share. The actual earnings per share was $1.04. They beat the expectations by 19 cents. That's a 22.35% increase. And what happens to the stock's value? It falls. It just defies logic from that standpoint. But that's what a lot is happening right now in the market. It's defying logic. So when we look at the earnings that happened back here, this was right after the market took off. All right, now let's see what else is happening. We had the most recent earnings call, and it was beating the expectations by not 22%, but by 23.6%. So when it beat it by that much, you would think, wow, it's going to grow that much too. But it didn't. What happened? Oh, there it is. That's what happened. Sometimes you can't make people happy no matter what you do. So that's what happened from this standpoint. That's why speculating on these stocks is so hard to do. There's so few people that actually make money off of it. If you want to use these as an investor is somebody that invests for the long term. Now, I want to talk to you just for a second about that. So I'm going to make this go away so that you and I can see each other. If you invest in cycles, then you have a better potential for making profits. Now, the bull market that we saw previously lasted for about 3 years, and the average bull market lasts for about 3 to 4 years. The average bear market lasts for about 18 months. Now, granted, the bear market that we saw because of the COVID pandemic only lasted 3 months. Actually, we're already into the next bull market, amazingly enough. But when you look at that over a period of time, the average cycle of bull and bear markets is generally about 5 years. If you can invest with the potential of going through at least 2 cycles, then you have a higher probability of making profits. And that's the whole idea here, is beating the odds. If you're here today to try to game the market, the probability is, I don't care who you listen to, what daytime broker, day trader that you're listening to, it's probably not going to happen. Now, if you don't believe me, that's okay. Don't believe me. If you want to try and do it on your own, I'm going to tell you how to do it and not spend a penny. Download an app on your smartphone that's called Webull, Webull. It's kind of like Robinhood. I haven't used Robinhood, but I've used Webull just for the sake of understanding the way it works. They have a paper trading account. So you can go out there and you can say, okay, I'm going to go buy big lots and I'm going to make a fortune. Well, okay, go ahead, try it. Imagine you can use imaginary dollars. You can put $1 million in the market, imagine, and trade it just like you would normally. And if you had $1 million invested in it, you can see how it goes. Okay. Then come back here when you find out that it doesn't work, and I'll give you the strategies for investing long-term, because most of the time, the day trading strategies don't work for most people. Most people don't have the time to do this every day. And the person that's out there that says you can day trade for 30 minutes a day. Okay, again, try to do it paper trading and see how it works. Then come back and see me. Okay, let's get back over to the stocks that we're talking about today, because I'm not here to lambaste you with things you shouldn't do. I want to tell you about things that you should do. So as we move forward here, let's go on and talk about the beta of this stock. Remember, the beta is the comparison to the volatility of this S&P 500. This is another stock that what happened is it was more volatile, but it was much more separated, and it had maybe calmer time periods. So when it averaged out, the beta is actually less than the market. It's less than the S&P 500, and I know that's confusing, but that's why you have to do a check of what the numbers are. Don't just go out there and say, I want to invest in low beta stocks. So I'm going to go out there and I'm going to buy Dollar Tree and I'm going to buy Citrix Systems because Van Richards said I should do that. No, I didn't tell you you should do that. What I told you is you have to double check yourself to make sure that you're investing to your own expectations, what you need, not because somebody else said that's what you should be doing. So if we look at the beta is 0.61893. It's deceptive. It should actually probably be higher than that. The PE ratio gives us a little bit better understanding when we look at the price earnings ratio. It's 27.9. It's a little bit less than the average market, which is around 30 right now. So that tells us from that standpoint. Okay, when we look at what some of the analysts are saying, this is Morningstar's take on it. They're giving this 2 stars, and they're saying that the fair value of this stock is $85 per share. And the last close today was 93.68. So they're giving it 2 stars. Now, when we look at what the other analysts are saying about Dollar Tree, they're saying, let's see, I went ahead just a little bit too fast. Let's back up here for just a second. We can see that there were 16 analysts that were giving projections on this. Remember, analyst is just a projection. It's not a guaranteed. Past performance is no guarantee of future results, that kind of good stuff. Out of the 16 analysts, 8 of them are saying that Dollar Tree is a strong buy, and 8 of them are saying that it's a moderate buy. There's nobody out there from an analyst standpoint that's saying you need to get off this ship. When we look at the graphs of it, just kind of gives you a little bit different view. When we average it out, it's really saying that it's a moderate buy. But please remember, this is not a buy-sell recommendation. I'm not telling you to go out there if you've got the stock to get rid of it. And I'm not telling you that if you don't have it, that you should buy it. I'm telling you that you need to look at your own financial situation. You need to determine if a stock like this fits into it. I'm here to just give you an education on what the general markets are doing and give you some idea of what you might expect going forward. Okay. Again, this is one of those stocks that if you're trying to put together a portfolio that has dividends for income or it's going to grow by dividends, this is not a stock for you. So I hope this has been helpful to you. If it has, I'm glad. Give me some comments if you listen to this. If you're not listening to it live and you want to give some comments later on whatever platform that you're listening to this on, whether it's Twitter, Periscope, YouTube, Facebook, or over on LinkedIn where we share it, just give me some comments. Let me know what you think about it from that standpoint. The other thing is too, that if you need help with your retirement planning, feel free to get in contact with me. One of the best ways to do that is you go to my webpage, which this is what it looks like, at richardsfinancialplanning.com. And if you go down to the teal button that's down here, you'll see schedule a call to learn more, and then you can sign up to set aside some time. You and I will have a telephone conversation about what your questions are. And I'll remind you that I have a very simple process. And if you go to my website, you can learn a little bit more about that process before you schedule a call, and then we get a chance to talk. So with that, I'm going to go on over to the next slide and end for the day, and wish you a very good evening. And we'll talk to you tomorrow.